The Nasdaq rose about 1.7% this week. If you just read the headlines or glanced at a financial news ticker, it sounds like another solid, breezy summer week for the market, right? You would assume your retirement accounts are looking healthy, portfolios are growing, and everything is moving generally up and to the right. But if you look under the surface, the Dow Jones Industrial Average actually fell. The Russell 2000 small caps fell. 8 of the 11 stock market sectors finished completely red. We had a green headline index, but a market that was mostly bleeding underneath. Theo, how exactly does that happen in a single week?
It happens when a market becomes historically narrow. You have just 3 gigantic names doing virtually all of the heavy lifting for the entire capitalization-weighted index. This week, we saw one of the most intense illusions of strength we have seen in months. The index looks perfectly fine because those giants are mathematically dragging it higher. But the average stock in your portfolio probably felt like it was having a genuinely rough time. The central question for next week is simple. Does the rest of the market wake up and join the rally? Or does the weight of everything else finally drag those 3 giants down? Let us unpack the tape. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Welcome back to the weekly review, everyone. Let us start by framing exactly what we are looking at, because the contrast is absolutely striking. You just mentioned the illusion of strength, and that is really the core story of the week. This was not a broad, healthy market advancing together. This was one of the narrowest rallies we have witnessed in recent memory, where the headline masks a lot of underlying pain across multiple industries.
Exactly, Maya. Think of the market like a massive parade. Normally, in a healthy economic environment, you want to see all the floats, all the marching bands, and all the participants moving forward down the street together. This week, we just had 3 massive, heavily decorated floats at the very front of the parade moving at top speed, while almost everyone else was either standing still or actively walking backward. That gap between the headline index going up and the average stock going down is the entire story of the week. When you strip out a tiny cluster of giant AI and semiconductor names, most equities had a genuinely rough 5 days. It is a classic bifurcation, and it forces us to ask whether the generals can keep advancing without their troops to support them.
Let us put some exact numbers on that scoreboard, comparing Friday's closes to the prior Friday, July 2nd. The Nasdaq finished up about 1.74% to close at 26,282. The S&P 500 added 1.23% to end at 7,575. But then you look at the Dow, which was down 0.5% to 52,637, and the Russell 2000 small caps down about 0.6% to 2,978. It is a stark tale of 2 markets.
And while that stark divergence was happening, the VIX, the market's fear gauge, actually fell to about 15, dropping almost 7%. So there is a calm on the surface. Investors are not panicking or buying insurance. But underneath, the bond market was moving in a way that creates friction. The 10-year Treasury yield rose 8 basis points to close at 4.57%, which is starting to put a little bit of a squeeze on equities that rely on cheaper borrowing costs to fund their operations.
The sector breakdown really highlights the severity of that narrowness. Only 3 of the 11 sectors actually rose this week. Energy led, up about 3.5%. Tech was up 2.9%, and communications gained about 1.9%. That is the entire list of winners. If you were parked there, you had a great week.
Right, and the other 8 sectors fell. Materials was down 2.2%. Healthcare fell 1.8%. Industrials dropped 1.1%. Consumer staples fell 1%, and utilities were down 0.8%. So if you were not heavily concentrated in tech or energy, you were likely losing ground. It is a very stark picture of who is winning and who is paying the price for this narrow rally. The market is not rewarding diversification right now.
Let us walk through the arc of the week, because the daily action was pretty telling and full of reversals. Monday and Tuesday opened with everyone hyper-focused on a potential rotation from chips to software. Samsung reported a record quarter, but the stock surprisingly sold off about 7%, which really rattled the memory chip space and made people question the momentum.
Then came Wednesday, which was a clear, unmistakable risk-off day. The Dow fell over 1%, logging its worst day in 4 weeks. We had a sudden escalation of tensions in the Strait of Hormuz, bumping up oil prices, combined with hawkish Fed minutes showing some officials had actually wanted to hike rates in June. But the critical tell here was volume. Semis bounced on very light volume, while software sold off on much heavier volume.
Thursday gave us a broad, enthusiastic rebound. SK Hynix saw its stock listing oversubscribed by about 7 times, and we had reports about Meta's in-house AI chip plans hitting the wires. That sent memory and chip equipment names rocketing higher. Notably, the mega caps lagged a bit on Thursday while small caps led, giving us a brief, teasing hint of a broadening market.
But Friday slammed the door completely shut on that hope. The market narrowed right back down to its familiar pattern. Nvidia and Meta reasserted their absolute leadership. The SK Hynix listing turned into a classic sell the news event. Memory gave back its Thursday gains, and software remained relentlessly weak. We ended the week exactly where we started, completely dependent on a handful of giants to keep the indices afloat.
When we look at the individual names, the dispersion is just staggering. The winners were a very tight AI-flavored group that just kept pulling away from the pack. Meta was the absolute monster of the week, surging about 14.8%. Broadcom was up 11%. Nvidia gained 8.3%. Vertiv was up 6.1%. Vistra gained 5.2%. And the semiconductors ETF, SMH, rose 3.2%.
And the losers were basically almost everything else in the market. As we mentioned, the materials sector was down 2.2%. Importantly, 2 of the market's unquestioned power infrastructure leaders took hits. GE Vernova was down 1.9%, and Cameco was down 0.6%. In the software space, Palantir fell 1.9%, and Salesforce dropped 1.7%. This extreme narrowness is the ultimate tell. Even strong secular leaders in power and infrastructure had to take a back seat to the pure AI hardware trade.
Okay, Theo, unpack this one for me. We talk about breadth a lot on this show, but for someone just looking at their portfolio, why does it matter so much how many stocks are participating, rather than just looking at the headline index number and celebrating a green week?
It is a great question and an important teaching beat. When a rally rests on a handful of names while the average stock is falling, that narrow leadership is historically a late cycle characteristic. Imagine a large roof being held up by 50 pillars. If 47 of them start to crumble, the 3 remaining pillars have to carry the entire weight of the structure. It is not necessarily an immediate death sentence for the bull market, but it is a giant yellow flag waving in the wind. A healthy, robust bull market broadens out. It lifts all boats and shows widespread confidence across the economy. A tired one narrows down to its most reliable generals because investors are afraid to buy anything else. This is a likelihood read, not a prediction. No one knows next week's tape, but breadth tells you the true structural health of the trend.
Let us dig deeper into that software versus semiconductors bifurcation, because it really hardened into the defining feature of the week. Money violently crowded into semiconductors and compute, companies like Broadcom and Nvidia and the SMH ETF, while software just kept correcting, with names like Salesforce and Palantir continuing to slide despite their own AI narratives.
The thing to watch here is the crowded trade tell. Let us go back to Wednesday's risk-off session. On that day, semis actually rose, but they did it on incredibly light volume. Meanwhile, software sold off on heavy volume. That specific pattern, light volume on the way up, heavy volume on the way down, is often the fingerprint of big money quietly distributing their shares. Institutions sell into strength on low volume to avoid crashing the price, while dumping their weaker positions more aggressively. Semis are strong, but very crowded. We have to respect that volume tell.
One area of the chip market that was particularly wild this week was memory. It was like a pendulum swinging violently back and forth. We had Samsung reporting a record quarter, but selling off. Then SK Hynix seeing massive demand for its listing, rocketing the space higher on Thursday. But then Friday, it gave almost all of it back in a sharp reversal.
It was a brutal round trip for anyone trying to trade the daily noise. But the key takeaway here is that this volatility was entirely about market positioning in an IPO event. It was not a break in underlying demand. The market simply used the SK Hynix listing as a liquidity event to sell the news. Memory remains in a deep structural shortage driven by two-sided demand, high bandwidth memory for the cloud and data centers, plus edge AI demand for consumer devices. Do not confuse a positioning round trip with the long-term thesis cracking.
Moving to our power and grid theme, we saw a really split week. The data center cooling and independent power names were outright leaders. Vertiv was up 6.1%, and Vistra was up 5.2%, continuing their massive momentum. But the equipment and materials side took a breather after their massive recent run.
Yeah, GE Vernova slipped 1.9%, Cameco was down 0.6%, and the broader materials sector fell 2.2%. The important read here is that this looks like a natural pullback within a completely intact thesis. The equipment order backlogs for these companies are still running 24 to 36 months out. The fundamentals have not broken. The tape just simply rotated its capital toward AI hardware for a few days to chase that momentum.
That makes a lot of sense. We also noted that Hubble was added to the board as a grid hardware leader to watch, and names like Cameco screened as technically oversold, with its RSI hovering near 38 around the low 90s level, which caught the attention of some technical analysts.
Laughs. Yes, though we always have to remind folks, these are purely levels to watch and areas where traders look for support zones. It is absolutely not advice to buy calls or jump in blindly. Always do your own diligence. But the structural power narrative remains one of the strongest and most visible in the market, even with this week's slight pause.
Let us zoom out and look overseas. The biggest data print internationally came from China, where producer prices jumped 4.1% year-over-year in June. That is a near 4-year high, and it officially ends a multi-year stretch of factory deflation for them, which has huge implications for global supply chains. Consumer prices there were milder, up just 1%.
That producer price jump is a genuine reflation signal out of the world's factory floor, and it is something the global bond market will be watching very closely because it can export inflation globally. Meanwhile, in commodities, we had that brief spike in oil on the Strait of Hormuz tensions. The U.S. oil ETF was up about 4.5% on the week, though the immediate scare faded by Friday. Gold was basically flat, down 0.3%, and the dollar was roughly flat, showing no real systemic stress outside of energy.
Back home, the macro picture is getting a bit more complicated for the stock market. The labor market stayed firm, with weekly jobless claims coming in around 215,000, showing people are still working. But the Federal Reserve definitely tilted more hawkish this week, which caught some off guard.
They really did. The release of the June meeting minutes was a bit of a shocker. It revealed that some officials had actually wanted to hike rates at that meeting. The market, which had been comfortably pricing in rate cuts, suddenly had to digest the fact that no cuts are imminent. And a few fringe voices are even talking about a possible hike later in the year if inflation stays sticky. The 10-year yield rose 8 basis points to 4.57%. A firmer economy plus a hawkish Fed is a serious headwind for a narrow tape.
There is also a huge structural story happening quietly in the background regarding the Fed. Fed Chair Kevin Warsh officially announced the leadership of 5 new task forces to fundamentally reshape how the central bank operates. They are covering communications, the balance sheet, data, productivity and AI, and the inflation framework.
This is a monumental shift. They're bringing in serious outside experts. You have Mark Andreessen advising on AI and productivity, Walmart's Doug McMillon focusing on real-time data, plus a panel of outside economists reviewing their frameworks. The direction here is what matters. Less forward guidance, a structurally smaller balance sheet over time, and treating AI as a disinflationary force. It is also a profound acknowledgement that inflation can be fiscal, meaning government spending, not just interest rates, drives prices.
And while they are planning a smaller balance sheet for the future, the current liquidity backdrop this week was actually quite supportive. Behind the scenes, bank reserves actually rose as the Treasury drew down its cash account.
Right, the Treasury was quietly adding liquidity to the system, which acts as a risk-on tailwind and helps explain why the VIX stayed so calm. But that dynamic will reverse when the Treasury has to rebuild its cash balance later, and Warsh's longer-term direction of a smaller balance sheet means there will be less liquidity support and less firepower for money printing down the road.
Looking ahead, next week's calendar is absolutely loaded. The biggest macro event is Fed Chair Warsh's semi-annual testimony to Congress on Tuesday and Wednesday. Given the hawkish minutes we just saw, this represents a real hawkish shift risk for the markets.
It is a massive week. We also have bank earnings kicking off in earnest. JP Morgan, Wells Fargo, and Citi, followed by Goldman and Morgan Stanley. But do not just look at the headline earnings beat. Watch the guidance closely. Bank profit growth is currently running at only about 6.5%, compared to roughly 23% for the broader S&P 500. A cautious outlook on consumer credit, whether everyday people are falling behind on their loans, could really pressure the financial group.
We also get the latest CPI inflation print, which is expected to pull back a bit, along with retail sales and industrial production. There is a lot of data to digest.
And if that is not enough, ASML and TSMC both report. Those two are the absolute bedrock of the semiconductor supply chain. Their numbers and guidance will be the real, unvarnished read on whether this AI capital expenditure boom is durable or slowing down.
While next week is heavy, the week after that, roughly July 22nd to the 29th, is what we are calling the mega cap capital spending kill check. We will hear from ServiceNow, Tesla, GE Vernova, IBM, all building up to Microsoft reporting on the 29th.
This is where the rubber meets the road. This is where we find out if this incredibly narrow AI leadership is actually earned. Are these companies turning that enormous AI spending into tangible financial results? If Microsoft hints that enterprise AI adoption is taking longer than expected, the reaction could be fierce. This upcoming earnings season is the ultimate validator for the whole thesis. Do the handful of generals currently holding up the entire market start to wobble under the weight of their own spending?
Let us bring it all home. The entire market leaned heavily on just a handful of mega-cap AI names this week. The single question that settles this tension is simple. Does the breadth finally broaden out? Do the Russell 2000 and those 8 lagging sectors join the rally and heal this bifurcation?
Or does the headline index finally roll over to meet its weak internals? If a hawkish Fed and thin participation crack this narrow tape, the drop could be sharp. The subtels we are watching closely are bank earnings guidance for the health of the consumer, the CPI print for the rate path, and the distribution volume in those crowded semiconductor trades.
Liquidity is still acting as a tailwind for now, but as we discussed, a rebuilding Treasury cash balance and a hawkish-leaning Fed are very real clouds forming on the horizon. We have to respect both the momentum and the risks.
Absolutely. Again, this is a likelihood read, not a certainty. But the balance of probabilities says that a market resting on 3 stocks is fragile. We need to see participation broaden out for this to remain healthy.
This was the week the green index masked a red market, and the final verdict now rests squarely on Q2 earnings, the upcoming CPI data, and Chair Warsh's testimony.
Thanks for joining us for the review. As always, everything we discuss here is for informational purposes. Remember to do your own research and diligence, as this is not financial advice. Have a great week, and we will see you next time.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.